Hi guys, so in this video we'll be discussing monetary policy. We'll first of all go over the concept of monetary policy and then the tools of monetary policy, which will be linked directly with expansionary and contractionary monetary policy. So let's discuss why the government uses demand side policies, which includes obviously monetary policy as well as fiscal policy. So this graph is known as the business cycle. The business cycle. And this straight line passing through the origin is the potential growth of the economy. It is the potential growth of the economy in the long run. The crest, this part, which is also labeled as upswing, this represents a period of boom, which is a very weird term, but it does exist. So it's a period of boom where the aggregate demand is high. The aggregate demand is high. Employment is also high. And obviously consumption is high. Right? And then this part, this down part, this part represents, downswings, as the name suggests. And so over here we have, low aggregate demand, high unemployment. And so this part is known as a recession. Like this part is known as a recession, and the other part, this part, is known as upswings or boom, right? So the thing is, the government uses demand side policies because the government doesn't really want this graph to, move up and down like it is right now. The government wants to stabilize the magnitude of change. And so the government uses demand side policies to, lower the magnitude of the boom, just as the green line represents. And it also wants to lower the magnitude of the recession. So this is what the government aims to achieve. Then let's move on to the different tools of monetary policy. The first tool of monetary policy is interest rate. Now, interest rates, it's a very interesting concept. So let's say if I was to go to a bank right now. This is a bank. This is me again. Right? So I go to the bank and, if I borrow some money from them, let's say $100, then when I return back the money, I won't only return back $100, but at the same time, I will return back $100 plus the interest. Right? And this interest, let's say if it is 5% in this case, and so I will return back 100 plus 5% of 100 rupees, or $100 in this case. So this is the concept, right? This is, the interest rate. But at the same time, if I was to, let's say, go to a bank, this is again me. If I was to go to the bank and deposit some money inside the bank, let's say again $100, then I will also earn interest on this 5%. Let's say 5%. So I will earn money off of the money which I deposited inside the bank, right? I'm going to earn money. I'm going to earn on top of this. So this is the basic concept of interest rates. So in monetary policy, the government can, either increase the rate of interest, right? The government can either increase the rate of interest. But how does this happen? How does the government really increase the interest rate? Well, the thing is, by definition, interest rates is equal to the cost of borrowing. Cost of borrowing, because when we borrow money, we have to pay interest rate, right? And so if the interest rates go up, we have to, pay more money back. And so the cost of borrowing increases. So this is one definition. And at the same time, interest rates also represent the price of money. The price of money. Now, this is a very important concept because let's say this is how the government really manipulates the rate of inflation, the rate of interest, the economy, right? Because, money also has a price. And price is determined by demand and supply. Demand and supply. Sorry for the bad writing. And so, if let's say the government increases the supply of money, if the supply of money goes up, then there is a surplus in the economy of money, right? And so according to the price mechanism, well, if there is a surplus, then the price will come down, right? The price will come down. And so because now we have a surplus, and so the price will come down, well, to remove the surplus or to get rid of the surplus and reach back to equilibrium. And so whenever the government increases the supply of money, the price of money goes down. Let's say the supply is increased, then the price of money goes down. And since we just discussed price of money is the same as interest rates, so interest rates go down too. Interest rates go down too. Now this can have two effects. Whenever the interest rates go down, we can say, well, it's part of the government's expansionary policy. Now, what does the word expansion mean? Expansion means to increase something, right? And in economics, when we say the government uses, well, expansionary monetary policy, that means the government is using monetary policy to increase aggregate demand. Aggregate demand obviously has different components: consumption, investment, government expenditure, and exports minus imports. So the government is trying to well increase the aggregate demand, and so increase all of these components somehow. So when the interest rates, let's say if the interest rates go down, then it's, well, first of all, the cost of borrowing goes down according to the definition, right? The cost of borrowing goes down, people borrow more money, since, well, they now have to like pay back less money to borrow more, and so people borrow more. Hence, consumption goes up, right? People borrow more, consumption goes up, which is also a component of aggregate demand. So, well, C goes up in aggregate demand. At the same time, investment goes up because, well, firms can now borrow money easily because, well, they have to pay less. So these two things go up. So this is the internal effect. Like, this is the internal effect within the economy. Aggregate demand goes up, consumption goes up, right? But at the same time, since, well, if I was to go to the bank, let's say, and deposit some money over there, 100 rupees or dollars, whatever you want to call it, then I would earn less money of the money which I deposited, right? Because we just discussed that in this case over here, that I would earn interest, this part. I would earn interest if I was to deposit money. And if the rate of interest goes down, well, now I will earn less interest. Let's say it's from 5, it goes down to 3%. And so now saving in the economy will go down. Saving in the economy will go down. So all of these things are part of the internal effect inside the economy. But there's also an external effect. Let's discuss the external effect. And all of this is related to, well, when the interest rates go down, right? When the interest rates go down, the external effect is, well, let's say if people from other countries, foreigners, if they had money inside our banks, when our interest rates, money inside banks, when our interest rate was high. So at that time, they were earning more money. Since you earn money when you deposit money inside the bank, right? You earn interest of that money. And so they were earning more money. But now, when the interest rates have gone down, right? When the interest rates go down, now they're earning less money. And so they take out their money from our banks. They take their money back or, well, deposit it somewhere else where the interest rate is high. And so this money leaves our economy. And this money is termed as hot money, which is again a very weird term, but, well, this is the term itself, hot money. So hot money, well, is money which foreigners or people in other countries deposit into different countries to earn money from their high interest rates. From their high interest rates. Right? So we just discussed how there can be, obviously, there will be an internal effect. The aggregate demand will go up, consumption will increase, investment will increase, the saving will go down. And externally, Well, now since our interest rates have gone down, people will take out hot money from the economy. Well, let's say if all this comes under the expansionary policy, the expansionary part of monetary policy of the government, expansionary, because well, the aggregate demand is going up, right? But let's say if the government was to increase the interest rates, then the opposite would happen. Like over here, we discussed the aggregate demand would go up, right? When we have a expansionary monetary policy, and so if the opposite was to happen, aggregate demand would go down, the cost of borrowing would increase, cost of borrowing would have increased, cost of borrowing would have increased, aggregate demand would have fallen due to decrease in consumption and investment, right? This is one thing. People will save more money because when the rate of interest is high, when interest rates are high, people earn more money when they deposit their money into the banks, right? And so people will now earn more money. That's one more thing. Another thing as well, if the rate of interest are high, then more hot money will come inside the economy. So, well, this is the whole concept of interest rates linked to monetary policy. Moving on, there is also another concept, money supply. And so what the government can do as well, either increase the money supply or decrease the money supply. Right. So the second tool of monetary policy is money supply. Right. So it basically means money within the economy. So that's one thing to really think about. So now what the government can do is, let's say if the government is following its expansionary fiscal monetary policy, if the government is using its expansionary monetary policy, which means obviously increasing aggregate demand, the government will increase the money within the economy. The government will increase notes and coins and stuff. Notes and coins to increase the amount of liquidity within the economy. If there is more money within the economy, then obviously people will buy more, right? Liquidity of money, more liquidity of money within the economy, and so aggregate demand just goes up. At the same time, there is another thing, liquidity ratio. So this ratio is set by the government or the central bank for all the commercial banks. So let's say if the liquidity ratio is high, then the ability of these commercial banks to lend money will reduce, and now they can lend less money. But since in this case we're talking about expansionary, which means we have to increase aggregate demand somehow, so what the government will do is the government will lower the liquidity ratio. And when the government lowers the liquidity ratio, then banks can now, instead of the ability of banks to lend money going down, the ability of banks to lend money will go up, right? And so banks can now lend more money. If lending increases, people will now borrow more, and they will have more money, which is a very basic concept, and then they can obviously spend more, which means aggregate demand can increase, right? So this is one thing. If the government was to use, let's say, contractionary monetary policy in this case, then the government will have to reduce money supply. So the money supply within the economy will go down. So they will reduce the supply of notes and coins. That's one thing, to reduce aggregate demand. But at the same time, what they will do is they will increase the liquidity ratio, as we discussed before. So the government will increase the liquidity ratio. Liquidity ratio goes up. because of which, well, people now won't really have more money, because when the liquidity ratio goes up, the ability of banks to lend money, goes down. And so, well, people will obviously, the borrowing goes down since they can only loan so much, right? Because of which aggregate demand will go down too. So this is money supply. Moving on to the last tool of monetary policy, which is exchange rates. Right. So the third tool of monetary policy is exchange rates. Well, exchange rates, as the name suggests, is the rate of exchange. But of what specifically? Well, in economics, rate of exchange of currencies. Currencies. Let's take an example of Pakistani rupee and US dollars. Okay, so in this case, if I had $1 US, I would be able to buy 100 Pakistani rupees. Okay, so this is the rate of exchange. This is the rate of exchange. Let's say if this was to change somehow, right? If the currency was to devalue to not 100, well, 150 to 150 rupees to $1. So now in this case, if I had $1, I would be able to buy 150 Pakistani rupees. So this means the value of the Pakistani rupees has decreased, right? Because for the same amount of US dollars, I can buy more Pakistani rupees. And so we can really say Pakistani rupee has devalued in terms of the US dollars, which, well, makes sense. So this is related to, well, monetary policy, because as we already know, monetary policy is all about aggregate demand, and so is fiscal policy, right? And so it's C plus I plus G plus X minus M. Here X represents exports, and M represents imports. Right? So we have exports and imports. So let's say if this case was to happen in real life, if the value of the Pakistani rupee was to devalue, which has already happened, right? And so if this was to follow, then people from the US, they now can buy more of our goods with the same amount of money. Because let's say if they were buying something worth 50 rupees, right? Let's say Lay's from Pakistan or something like that. So they were initially able to buy 2 packets. But now, since the value of the Pakistani rupee has devalued, their currency remains the same. The value of the Pakistani currency has devalued, and so they can now buy, well, with 150 rupees. Obviously, since the value of Pakistani rupee has decreased, they can buy 3 packets of chips. Because of which, our exports increase. But this obviously depends on the elasticity of our exports. If the demand of our exports is, well, let's say elastic, then obviously it will increase. But if it's inelastic, then it will increase, but not by the same proportion. So this is one thing. And at the same time, for Pakistan, let's have a look at Pakistan now. For Pakistanis, if they were to use, well, 100 rupees, they would get $1 in return, right? And so they would be able to buy something that was worth $100. But now they have to pay 150 rupees to get $1. And so they can only buy something worth $1 if they use 150 rupees. And so for Pakistanis, the cost of imports go up. Right? And so depending on the elasticity of the good again, the imports may fall. That is, if the demand is, let's say, price elastic, then the imports will fall by a greater proportion as compared to the change in price. And obviously, if the demand for the good is inelastic, then the demand will fall by a lesser proportion as compared to price. So all of this is part of PED, price elasticity of demand, and so I won't really go into much detail about that right now. So all of these tools altogether, exchange rates, money supply, and interest rates, are known as the tools of monetary policy.